Assalamualaikum warahmatullahi wabarakatuh. We are from group 3. We'll present about current value accounting. Okay, from the first
one, there is Lian Alvionita Sari with 3 last ID number 128 and Alya Atifa Nurrohmah with 3 last ID number 193, Melinda Dwi Harwanto with 3 last ID number 214, Gevin Nadila Febrianti with 3 last ID number 456, and the last one is Novia Setyo Ambarwanti with 3 last ID number 460.
Okay, in here I will explain about the relevance of the profit concept. So profit is a staple of financial statements and has many benefits in various ways that are commonly viewed as the basis for taxes, dividends, investments, decision-making basis, and predictions. First, profit is the basis for taxation and redistribution of wealth according to the rules prescribed by government fiscal regulations. Second, earnings are seen as the basis for dividend policy and corporate retention. Liquidity and investment prospects are additional variables necessary for the determination of dividend policies. Third, earnings are seen as a general basis for investment and decision-making. Fourth, earnings are considered as a predictive tool that helps in forecasting future earnings and economic events. There are three dimensions of smoothing that can be identified: smoothing through event occurrence or recognition, smoothing through allocation over time, and smoothing through classification. The fifth way is that earnings can be seen as a measure of efficiency. Profit is a measure of both the skill, stewardship of management over the entity's resources and its efficiency in conducting the affairs of the company.
The next material about advantages of accounting profit. The following are arguments for several defenders of accounting profit, including Ijri, Kohler, Littleton, and Maus. There is an advantage of accounting profit. The first one is that it can withstand the test of time, namely accounting profit is a determinant for the practice and mindset of decision makers. The second one is since accounting profit is based on actual and factual transaction, it will be measured and reported objectively and is therefore essentially variable. The third one is by relying on the realization principle for revenue recognition, accounting profit meet the criteria and conservatives. And the last is accounting profit is considered useful for control purpose, especially in reporting management. In addition to being strongly defended, accounting profit have also been severely criticized for various limitations, including the first one is stating that accounting profit is unable to recognize the increase in the unrealized value of assets owned in a certain period due to the application of historical cost and realization principle. The second one is that the dependence of accounting profit on the historical cost principle make comparability difficult, give the difference method recognition in calculating costs. And the last is the dependence of accounting profit on the realization principle, the historical cost principle, and conservatism give rise to irrelevant data. The next material about advantages of accounting profit. The following are arguments for several defenders of accounting profit, including Ijri, Kohler, Littleton, and Maus. There is an advantage of accounting profit. The first one is that it can withstand the test of time, namely accounting profit is a determinant for the practice and mindset of decision makers. The second one is since accounting profit is based on actual and factual transaction, it will be measured and reported objectively and is therefore essentially variable. The third one is by relying on the realization principle for revenue recognition, accounting profit meet the criteria and conservatism. And the last is accounting profit is considered useful for control purpose, especially in reporting management. In addition to being strongly defended, accounting profit have also been severely criticized for various limitations, including the first one is stating that accounting profit is unable to recognize the increase in the unrealized value of assets owned in a certain period due to the application of historical cost and realization principle. The second one is that the dependence of accounting profit on the historical cost principle make comparability difficult, give the difference method recognition in calculating costs. And the last is the dependence of accounting profit on the realization principle, the historical cost principle, and conservatism give rise to irrelevant data.
Okay, so now I will explain the material about the nature of the economic concept of profit. Adam Smith was the economist who first defined profit as an increase in wealth. Most classical scholars, especially Marshall in particular, followed Smith's concept of profit and linked conceptualism to his business practices. Lian introduced the concept of profit as interest, which refers to the continuous appreciation of capital goods over time. The difference between interest and consumption over a period of time is expressed as savings. This idea leads to the generally accepted concept of economic profit as consumption plus savings expected to occur over a period of time, savings equal to the change in economic capital. This can be expressed by the identity YE equals C plus KT minus KT minus 1, where YE is economic profit, KT is consumption, KT minus 1 is capital in period T, capital in period T minus 1.
Okay, the next material is about the concept of capital maintenance. The concept of capital maintenance means that profit is recognized only after a company's capital is preserved or the costs incurred have been recovered. In practice, there are four main concepts of capital maintenance. First, the concept of financial capital maintenance view capital in nominal monetary terms. As long as the amount of monetary capital remains the same or increase, the difference is considered profit without inflation into account. Second, the concept of general purchasing power financial capital maintains capital in constant purchasing power. Under this concept, before profit is recognized, capital must be adjusted for inflation to ensure its purchasing power is preserved. Third, the concept of bicycle capital maintenance assesses capital based on productive capacity. Profit is recognized only if the company is able to maintain the same level of production without regard to monetary value. Fourth, the concept of maintaining productive capacity is called in constant purchasing power is a combination of the previous concept, namely preserving production capacity while also considering change in purchasing power due to inflation. Thus, the essence of all this concept is that profit is recognized only as the access after ensuring that capital, whether in the form of money, purchasing power, or productive capacity, has been maintained.
Okay, the next is about current value concepts. Current value can be calculated based on first one is capitalization, the second one is current entry price, the third one is current exit price, and the last one is combination of the value generated by the above three methods. And for the next, we will discuss about capitalization. To calculate this capitalist value, there are four variables that must be known. The first one is the expression of cash flow that may arise from the use or disposal of the asset. The second one is the timing of the expected cash flow, and the third one is the number of years of the remaining life of the assets, and the last is the appropriate discount rate. If the above variable can be determined in an accurate and objective manner, the capitalization or present value method can be expressed by this formula, and where the formula and information that you can see in this slide in PowerPoint. And the next material that we will discuss is about evaluation of current cost of entry-based accounting. Current cost of entry describe the amount of money or other payments that will be required to acquire the same or equivalent assets. Here are some interpretation of current cost of entry that have been used. The first one is use replacement cost, that is equal to the amount of money or other payment required to acquire an equivalent asset in the second-hand market that has the same remaining useful life. And the second one is reproduction cost, that is equal to the amount of money or other payment that required to acquire an asset identical to an existing asset. The common feature of asset cost of entry ideas is that they relate to the cost of replacing or reproducing an existing asset. The issue that remains to be resolved is the selection of the measurement method of current cost of entry. The three most recommended methods are using market pricing, special price indicates, and appraisal or management pricing. And the next discussion is about current exit price. The current exit price represents the amount of cash for which an asset can be sold or a liability can be rescheduled. The current entry price is generally recognized to have a relationship with the one is the selling price under condition of planned rather than forced liquidation, and the second is the selling price at the time of measurement. Expected exit value or net realizable value is the amount of cash that will be received in an asset is expected to be sold or a liability is expected to be rescheduled. The main feature of the current exit pricing system is the complete abandonment of the realization principle for profit recognition. Valuing all non-monetary assets at the current exit price will result in the immediate recognition of all profits. Thus, operating profits are recognized at the time of production, while ownership gains and losses are recognized at the time of purchase and consequently are recognized when price changes occur rather than at the time of sales. The most important event in the current accounting cycle is the point of purchase or production rather than the point at which sales occur. And the last discussion is about the combination of the value generated by the above three methods. Several other current value accounting implementation proposals have been proposed as well. In this section, we will look at this proposal. For convenience, they will be grouped into the following categories. There are 5 categories. The first one is critical versus non-critical assets. Critical assets are determined based on the expected role of a particular asset in the entity's foreseeable future operation that few generally will either continue or discontinue use. Non-critical assets are valued at the current value exit price. Critical assets are valued at their current entry price. The second one is value to the firms. According to the value to the firm approach, assets are valued at an amount that reflects the opportunity cost to the firms. Like in example is the maximum possible loss if the firm were to lose them. And the third one is purpose replacement cost from the SIC. As a first step toward correcting some of the limitations of historical cost accounting, the Securities and Exchange Commission or SIC is called replacement cost as a method of replacement, a mandatory disclosure method for large companies. Replacement cost is defined as the smallest amount that must be paid in the course of normal business operation to acquire a new pieces of equipment operating at productive capacity. The fourth one is value combination. The value combination approach tries to avoid some of disadvantage of current exit price, current entry price, and other capitalization methods. And the last one is the concept of operating profit. Edward and Bell have introduced the concept of operating profit. Accounting profit is the differences between the realized income arising from transactions that occur during the period and the corresponding historical cost. Operating profit differs from accounting profit in two ways. The first one is operating profit is based on replacement cost valuation, and the second one is operating profit only recognized profit that are occurred during the period. More specifically, operating profit consists of the first one is current operating profit, the second one is realized and accrued ownership gains, and the third one is unrealized ownership gains and losses occurred during the period. In other words, operating profit is equal to accounting profit after deducting realized proprietary gains for the period in equation and occurred during the previous period plus unrealized proprietary gains and losses. And that's all our group presentation. Thank you for watching.
Okay, that's all presentation from Group 3. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.